Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open. A violent overnight rotation splits the market, with the Dow surging while tech plunges into a shadow war. Watch the bell closely as critical inflation data looms, threatening to trigger market chaos. Second, crisis looms. Europe's triple shock triggers historic pivot from US, redrawing the global trade map. As Europe forges a new trade alliance to sidestep America, a German trade chief warns the world has become more expensive. Is this the start of a new era of structural inflation that rocks global markets? Finally, Apple versus Google. A shocking alliance revealed as Siri gets a ChatGPT-style overhaul powered by its biggest rival. This stunning partnership signals a monumental strategy shift, but it also creates a massive geopolitical problem in China. Who really wins in this high-stakes bet? Apple by sidestepping billions in costs, or Google by getting its AI onto a billion iPhones? A deceptive recovery is underway. While the headlines scream rally, the internals tell a darker story of violent rotation that left the broad technology sector completely behind. Yesterday's session was a masterclass in market divergence, and today the bill comes due in the form of the most critical inflation data of the quarter. The S&P 500 and the Dow Jones Industrial Average surged more than 1% yesterday, riding a wave of relief after President Trump reversed his aggressive stance on Greenland and European tariffs. This geopolitical capitulation removed a massive risk premium from the market. However, do not let the green numbers on the big board fool you. The Nasdaq Composite barely budged, finishing flat with a meager gain of 5 basis points. This massive divergence signals that smart money is aggressively rotating out of high valuation technology and seeking shelter in financials and industrials. The market is not buying everything. It is selectively picking winners that can survive a higher for longer interest rate regime. The real test comes at 10 a.m. Eastern today. The Bureau of Economic Analysis releases the Personal Consumption Expenditures Price Index, or PCE, which acts as the Federal Reserve's preferred inflation gauge. This is the single most critical data point for the first quarter of 2026. Why is this specific release creating such tension? Because the market has priced in a stalled disinflation narrative. Consensus expectations sit at 2.8% year-over-year reading. If that number hits 2.8% or higher, the narrative shifts immediately. The Cleveland Fed's nowcasting model is already flashing warning signs of sticky inflation driven by service sector wages and the lagged impact of 2025 tariffs. A print at this level would confirm that the last mile of the inflation fight has stalled, forcing the market to price out rate cuts entirely for the first half of 2026. Currently, the CME FedWatch tool shows a 95% probability of a hold at next week's FOMC meeting. A hot inflation print today validates that restrictive stance. The impact on capital flows would be immediate and severe. With the 10-year Treasury yield already hovering near 4.3%, a spike here increases the discount rate for future cash flows, disproportionately punishing long-duration assets. This explains why we are seeing weakness in speculative growth names. Unprofitable software and social media stocks like Reddit and AST Space Mobile sold off sharply yesterday, even as the Dow rallied. Conversely, this environment acts as a tailwind for the financial sector, as major banks benefit from wider net interest margins when rates stay elevated. Beyond the macro data, the corporate earnings calendar is bringing the artificial intelligence trade to a crossroads. Intel reports after the bell today, and the stakes could not be higher. The stock jumped nearly 12% yesterday, effectively pricing in a perfect execution. The market is demanding validation of the AI infrastructure thesis, specifically data center revenue growth exceeding 30%. Intel has become the proxy for this trade. If they confirm that hyperscalers like Amazon and Microsoft are maintaining their aggressive spending on hardware, the semiconductor rally, which also lifted SanDisk by over 10% yesterday, has room to run. However, analysts warn that if guidance disappoints, the entire AI trade faces a harsh repricing. We are also watching a structural deterioration in the housing market that complicates the Fed's job. Pending home sales just collapsed over 9% to record lows. This freeze is caused by the lock-in effect, where homeowners clinging to 3% mortgages refuse to sell in a 6% world. While this weakness usually argues for rate cuts, the Fed is handcuffed by the sticky inflation data we are about to see. This dynamic creates a dangerous feedback loop where the economy slows, but rates cannot fall to save it. The next few hours define the trajectory for the rest of the month. We are looking at a binary outcome dependent on the inflation print this morning and Intel's guidance tonight. The divergence between the Dow and the Nasdaq is not a glitch. It is a feature of this new risk environment where profitable cash flow is king and speculative growth is being abandoned. Watch the 10-year yield closely at 10 a.m. That is the true north for this market. Heading into today's open, a stark warning from the CEO of Europe's largest port. We've been relying on cheap production in China, cheap energy from Russia, and cheap defense from the United States. And all three of these securities are falling away. That quote from the Port of Rotterdam's chief perfectly captures the mood coming out of the World Economic Forum in Davos, where frustration with President Donald Trump's tariff policies is boiling over. You see, for Europe, this isn't just about trade spats. It's a unique triple shock. The simultaneous loss of cheap Russian energy, reliable American security guarantees, and now stable US trade policy is forcing a fundamental pivot. Continuing our last discussion about the need for dual diversification, this isn't theoretical anymore. Europe's push for distance from both China and an increasingly transactional US is moving from boardroom talk to policy reality. This pressure is what's driving Europe to pursue what it calls strategic autonomy, trying to stand on its own 2 feet, which could create a more independent and perhaps more protectionist trading bloc that changes global investment flows. Global leaders aren't just talking, they are actively redrawing the world's trade map to work around the United States. A few days ago, we mentioned how companies have been diversifying supply chains. Today, there's another important update. The policy side is catching up. The European Union just signed its largest ever trade pact with the South American Mercosur bloc after 25 years of talks. At the same time, Canada and China have struck a deal to slash tariffs on electric vehicles. The situation presents a fascinating duality. On one side, this emerging plurilateralist bloc, think EU, Canada, Mexico, Japan, could stabilise global trade through diversification. On the other, it will also create new regulatory competition, challenging US dominance in setting international standards for decades to come. And the forecast from Boston Consulting Group is stark. The US share of global goods trade could plummet from 12% to just 9% over the next decade. One German export leader put it bluntly, saying Trump is soaring on the branch he's sitting on after data showed German exports to the US have already fallen by 9%. We previously analysed autos as the uncomfortable template for escalation. The fresh data now look eerily similar to that playbook. The detailed data backs this up. The latest figures show German exports to the US actually fell by about 10% over the last 11 months. The impact is especially severe in key sectors. Exports of German cars and auto parts to the US have plunged nearly 14%, while machinery and chemical exports are each down around 9.5%. As we flagged a while back, that's precisely the sector mix most exposed to tariff whiplash, and it directly challenges the narrative that tariffs help the domestic economy. This isn't a future problem. It's happening now. The Port of Long Beach reports its cargo from China has already dropped from 70% of its total trade to 60% as business shifts to Vietnam, Thailand, and Malaysia. But this is where the situation takes a more complex turn. This shift isn't as simple as it looks. It's less of a China plus one strategy and more of a China plus risk strategy. As we've discussed before, companies have spent years trying to diversify away from China. The twist now is that while final assembly may move to places like Vietnam, the supply chains remain deeply integrated with Chinese-made components and capital. Interestingly enough, this means US supply chain resilience is more fragile than the headline trade data suggests, leaving it still highly exposed to any shocks originating from China. For Chinese companies, this means they are moving lower value assembly abroad while retaining higher value component manufacturing and R&D at home, accelerating an industrial upgrade. The core conflict for markets boils down to a new reality where, as one German trade chief stated, the world has become more expensive and structurally it will get even more expensive. We're seeing hard evidence of this structural inflation. The latest ISM manufacturing report showed the overall manufacturing index fell to 48.2, indicating the sector is contracting. But at the same time, the prices index within that report surged to 65.4. We previously said this puts the Fed in an impossible position, raise rates to fight inflation or cut to support growth, and today's print reinforces that bind. And remember, the legal backdrop matters too. The use of emergency tariff powers has been under court review, so sudden changes in authority only compound the policy uncertainty. Watch for this theme to pressure multinational stocks at the open, particularly in the industrial sector ETF, ticker XLI. At the open, look for these firms to be under scrutiny as investors grapple with the rising costs and fracturing of global supply chains, which could directly squeeze their profit margins. Also, as we cautioned, if the US itself is the source of instability, keep an eye on the 10-year Treasury yields failing to fall would signal the usual safety valve isn't working. Speaking of the immense costs pressuring global players, our next story reveals a stunning alliance designed to sidestep billions in spending. Ahead of the bell, there's a seismic shift in the tech world. A blockbuster report overnight claims Apple is turning Siri into a full-blown ChatGPT competitor, and they're using a surprising partner to do it. Their biggest rival, Google. A while back, we laid out why an Apple-Google AI tie-up was likely. Today's report is the clearest blueprint yet for how it actually lands on devices. According to the report, Apple is planning a massive overhaul for Siri, transforming it from a simple voice assistant into a powerful AI chatbot built directly into iPhones and Macs. Internally codenamed Campos, the new Siri is designed for both typing and talking, and it's described as the primary new feature for the upcoming iOS 27 and macOS 27. Remember, Apple's privacy-first on-device approach had delayed next-gen Siri. This looks like the bridge we discussed a while back. Now, get this. For Apple's business, this integration is a critical test for monetizing advanced AI on a massive consumer scale. Success here could supercharge the iPhone upgrade cycle, pushing millions of users to buy new hardware for the best AI experience. Alternatively, watch for the possibility of Apple introducing a new AI Pro subscription tier. As we noted, though, the near-term playbook for foundation models has been massive business-to-business licensing modeled on the kind of default placement deal Google already has with Safari, so subscriptions may be additive, not the main event. This could fundamentally alter Apple's massive services revenue, which already hit over $100 billion last year, but that's not the whole picture. The real turning point is the engine behind this new Siri. Apple will reportedly use a custom version of Google's Gemini AI model. We previously flagged Gemini as the likely partner. Today's update points to a tailored model sitting under Apple's experience. This is, frankly, a stunning admission from Apple. The sheer cost of building a top-tier foundational AI model from scratch, the capital expenditure for data centers and specialized chips is becoming astronomical, even for a company with a balance sheet like Apple's. As we've been tracking, the AI infrastructure supercycle is in full swing. No surprise, companies like NVIDIA, which makes the essential GPUs for AI, are seeing data center revenue surge over 66% year over year. By partnering with Google, Apple is essentially sidestepping this incredibly expensive part of the AI arms race. This signals a monumental strategy shift for Apple, which has historically prided itself on building its technology in-house. Continuing our discussion on Apple's pivot from pure vertical integration to what we called ecosystem curation, Apple seems to be betting that the long-term competitive advantage, or moat, isn't owning the underlying AI model, but rather owning the distribution platform. With over 1 billion active iPhones, Apple has the ultimate distribution. This strategy suggests that foundational AI models could become a commodity, and the real value will come from who can provide the best user experience. The move is a direct answer to the pressure from OpenAI and Microsoft, which have dominated the AI conversation. As we mentioned, this could push OpenAI into more of a supporting role on Apple devices rather than being the default intelligence layer. However, if you zoom out, you'll see another layer of strategy at play, and it's a huge geopolitical one. Apple's reliance on a US-based Google model for its global user base creates a massive challenge in key markets, especially China. A while back, we zoomed out to the rise of sovereign AI in places like the EU and China. Today's report underscores that tension. Chinese regulations require AI services to be approved and hosted locally. This means Apple likely cannot use Google's Gemini in China and may be forced to partner with a local Chinese firm like Baidu. This could fragment Apple's seamless global ecosystem and set a precedent for other countries demanding their own sovereign AI solutions. This sets up a massive power struggle heading into today's open. For years, the story was Apple versus Google in the smartphone wars. Now, they are reportedly teaming up to fend off a common existential threat in artificial intelligence. The plan is to unveil the new Siri at Apple's developer conference in June and launch it this September. This news positions the AI battle as a three-way war between Apple, Google, and Microsoft. All eyes will be on how shares of Apple and Alphabet, Google's parent company, move as traders react to this stunning new alliance at the opening bell. At the open, look for traders to weigh who benefits more. Does Apple gain more by getting top-tier AI cheaply, or does Google win by getting its model onto a billion iPhones? Also, watch shares of the picks and shovels players in this AI war, particularly the chipmaker Nvidia, which trades as NVDA. As we've been saying, no matter which company wins the AI software race, the demand for the infrastructure, the data centers, the specialized chips, the power only continues to accelerate.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.